Hey everyone, welcome to CoveredCall ETF Investing, your central hub for deep CoveredCall ETF data, which we're going to be going through in this video, specifically looking at American CoveredCall ETFs. I know many of you have been waiting for this. Part of the CoveredCall ETF AllStar Tracker launch, I mentioned at the time that American funds would come out in March, and this would be part of like a major update as every month will be, but American funds more specifically in March. So I've delivered on that. We got 59 American funds to go through. Again, for those who are new, I've taken information from fund manager websites, information from places like Google Finance and Yahoo Finance, and merged it all into one place for consolidated, updated information that we can filter, that we can accelerate our education on, so we can identify opportunities. We can find those red flags. If you're someone who is interested in income investing and wants to use these style of funds to support retirement or early retirement or supplement expenses, it's like this is the undisputed tool I want to be that all of you guys go to for that updated information on a regular basis. And if you want this for yourself, totally available for you guys. Yes, I do videos on it, but you can pick it up in my Patreon on the homepage here, or it'll be in the pinned comments down below or in the description below. So many avenues you can pick it up for yourself. $13 a month. As I like to say, I don't think it'll break the bank even if you try it out one time. I think it's certainly more than worth the price for getting a list of all the funds that are out there, because if you're trying to look for this stuff on your own, I understand how difficult it is to look for this stuff, just to Google search it, and it won't come up with everything. I can guarantee you that. But enough with that being said, let's get into the tracker and look for those opportunities that we had mentioned. So again, the big updates, I included a tab for US listed funds. Keep it separate from Canadian funds. That way you guys can, if you want to sort of mix and match and filter stuff all by itself, you can do that specifically with American funds, and you can do it specifically with Canadian funds. I've also added a tab for volume. AUM and volume, I think, are going to be really good indicators of not just the health of the CoveredCall ETF industry, but funds themselves. Not all these funds are going to be around for 5, 10, 20 years. And I'm 34, so I still got more years ahead of me than I do behind me. So making sure that I'm invested in funds that have longevity is really important to me. And to be able to share that with all of you as well is also very important. So let's get into those opportunities. We got the filters up. If you need to create a filter in Google Sheets, just for those, just a little tidbit of info, I actually never used Google Sheets until I made this tracker. So if you are totally have never used Google Sheets before, trust me, I was in that camp about 5 months ago, and I had no idea how to use any of this stuff, but I wanted to learn, and well, here we are today. We got a Google Sheet with all this info. So if I can do it, you guys can do it too. So we're in a read-only format. If you want to create a filter view, head up to data, you just click on filter views, create a filter view, click on that, and it'll be able to filter. Because if you don't do that and you try to click on these little filter icons, it'll do nothing. You guys will see here, we got forward yield. Also have these little notes at the top here that kind of describes every column, what it means. But forward yield, for those who don't know, like how do we get that number? It's the current distribution, or the last distribution that was paid out, times it by 12 months, and divide by the share price. And this is how we get forward yield. So if the distribution stayed stable for a year, this is roughly what the yield would be. And then TTM, trailing 12 months, is it's basically the prior 12 months divided by the share price, the current share price. We get 19. But some of these funds are certainly not a lot newer, so I don't really pay too much attention to 12 months trailing yield. It can be kind of misleading because, again, some of those funds don't have 12 months of data. They might have 1 month or 2 months or 3 months, but forward yield kind of gives us a much better idea of of what could possibly be with each of these funds. So let's go ahead and figure out, especially for the American funds, yield on the American side certainly makes this space interesting to talk about, since they have some of the most insane yields out there. You're not seeing these yields like in the top, whatever this is, top 20. You're not seeing any of these yields at all on the Canadian side. So we can go through this, go through all the yields. What are some of the best yields out there, from the most insane yields at 85% based on, again, those last distributions, all the way down to the most kind of conservative ones being DYLG. Okay, they're all built differently. Again, not all covered call ETFs are created equal. Some are certainly way more aggressive. Some are very conservative. Some have been around for a long time. Some have been around for like not that long. And to see where longevity is going to last in some of these is going to be important to figure out. And that's precisely why, like I have, especially in this update, why I have an average 3-month volume tracker, because that in combination with assets under management, we get a general health of the overall industry with that, but we can also identify red flags and funds that could be sort of on the outskirts of funds that probably don't last, say 5, 10, 15, 20 years. And I don't know about you, I mean, I'm 34 years old. I know many of you who watch my videos are either retired or near retirement, and you just want the confidence in these funds. Can they stand the test of time? I do as well. I got more years ahead of me than behind me, so I certainly want these funds to last and be invested in the funds that I think can do just that. Now, covered calls have been around for a long time in of themselves. ETFs have been for a long time in of themselves. I think you combine the two, they'll be around for a long time, but it's just making sure that we're in the funds that certainly can hold up. And potentially some of you just want in some of these funds just for the swing trade or temporary, and that's fine too, whatever your goals are. But that's why for me, in doing videos like this, it's important to, yes, identify opportunities, but also the red flags as well. And we'll get to that in a bit. So let's keep moving through. We'll get to average volume in a bit. We'll kind of skip over that and we'll go straight to performance. Where we want to look for opportunities is, in my opinion, it's going to be a 6-month window. Why? Because 6 months is typically a good indicator of what kind of market cycle we've been in. Sure, we can look at the past 5 years and 10 years and we can go back as far as the fund has done. But now you're starting, if we go back 5 years, you're starting to encapsulate, a lot of different economic cycles, especially here in 2024. What did we see in the last 5 years? We've seen, the tail end of the 2010s, which were great years, especially if you were continually investing and buying assets. 2019, certainly good year. We had COVID. We have, I'll put it to you this way. In the past 5 years, we have sovereign debt crisis stuff going on. We got geopolitical turmoil. We have inflation. We have interest rates. So there is, and we've seen a bear market. There's been these mini bull markets in there. The tail end of, and with COVID, supply chains that have run amok. So a tremendous amount of economic turmoil. Hard to identify opportunities amongst all that. Not to say it's impossible, I think, but 6 months kind of gives us a better idea. So let's filter this by just what has been doing the best, right, in the last little while. So if we can see in the past week, we see that a lot of the UMAX stuff, naturally, because it's concentrated, it's just one thing. The more you are diversified, right, the less you're going to have these really tremendous price appreciation spikes like you see here with YieldMax. These ETFs invest in one stock. So again, the more concentrated something is, the better it can outperform. But what goes up must come down. So if it acts like this, when times are good, what do you think it's going to do when times are not so great? It's going to be at the bottom of the well. That's where it's going to be. And overall, in the past week, a lot of these funds have done really well. Why? They also invest predominantly in the tech sector. So if we look at, if we start with NVIDIA, where do we move over to? We go over to fund category. We can see crypto, technology. And I mean, that's the thing. With the CoveredCall ETFs in the US, it's going to be so technology dominated. So when it comes to actually identifying sectors that are what we could invest in, there's just not gonna be much to choose from. It's pretty much technology or nothing, all in or all out. So if we go down to the bottom here, what are we looking at as far as opportunity that we can start with? We'll start with the 1 week. We see technologies, FYLG, financials, the VIX shorting. Now this shorts the VIX. So the time, I think, as far as I understand, if you want to say with SVOL, right, it shorts the VIX, which is the volatility index for the S&P 500. You probably want to buy it when volatility is rising up, and then when volatility falls, that's when you probably stop buying it. I think, in my opinion, that's sort of the strategy with SVOL. But there's really not anything here that over the last week that is super down. If we go over to 1 month, what do we got here? We got, no doubt Bitcoin has done really well over the past month. Again, it's going to be technology heavy. But what I'm really interested in, what are the opportunities kind of lingering near the bottom? We got some Google over the past month, as we looked at in, so I'm not sure what's going on with Google there, but we see Goop or Curve's version, their single stock ETF, Google. So maybe there could be something there with Google. It's starting to kind of facilitate opportunity there. What do we got over the past 6 months? Again, it just goes to show how new some of these funds are, because we're not looking at many of them at this point. But over the last 6 months, wow, Coiny, Maxi have done fantastic. So if you're someone who really likes Bitcoin, boy, you've done extremely well while picking up a very good yield over that period of time. But near the bottom, let me guess. We got Google once again. We got Tesla at the bottom. Some of these bond ETFs are also down, or kind of hovering near the bottom as well. How many do we got here? All three of the big CoveredCall bond ETFs are down there as well. I don't know what it's going to do much for growth, because I know those bond ETFs invest 100% in, well, I should say up to 100% in their respective funds. If interest rates indeed do go below, if interest rates indeed do start to fall, at some point this year, sure, there could be opportunity there. I heard an interesting stat, I want to say a week ago, at least it was here in Canada, but Canada and the United States are so, our economies are so intertwined with one another that, what happens to one, there's another one that kind of reflects. Sector breakdowns are certainly different, but, here in Canada, we pretty much follow lockstep with whatever the United States does with interest rates. So at least here in the United States, with the last 6 months economic, or I should say the last 6 months of performance on just price appreciation alone, we're seeing maybe bonds, there could be an opportunity there. There is some sort of diversified stuff kind of hovering. I wouldn't say it's down, but it's gone up a couple of percentage points over the last couple of months. And for me, I'm in the marketplace for a diversified American CoveredCall ETF that I can put in my wife's spousal RRSPs. What is kind of interesting is on the American side, for Canadians, we have management fee, and then we have MER, so management expense ratio. And for the Americans, it's kind of more a case of it's just a gross fee. So that would include your trading costs. That includes your management fee. If there's leverage expenses as well. It's just all of it all in one. So essentially, it's just MER for Canadians that are watching. Again, portfolio coverage and moneyness, for those who are newer. Portfolio coverage, the higher the percentage is, and portfolio coverage, the higher typically the yield is. Moneyness, right? Something that's at the money is going to be more aggressive than something that's out of the money. And then in the money is probably the most aggressive you can possibly get. So just keep that in combination with one another. If you see something that's, say, 50 or 30% out of the money, you know it's going to be less aggressive, probably more price participation. If you want to be, seek yield and lean growth, which is what I typically like to do. I want to see price appreciation in the covered call funds I invest in. As far as dividend streaks are concerned, basically all these funds are variable. They move around. So unlike on the Canadian side where you've seen 100 plus months of a dividend streak, you're not going to see that here. So like the best streaks that we have are probably something like Yield Max's Facebook. That's a fund month over month that has been either stable or growing over time. I don't think there's really anything else there to look at. As far as distribution changes, we'll look at that month over month. It's going to get wilder. This is certainly going to be more exciting to cover here than the Canadian stuff. Most of the Canadian stuff is like 0%. A couple funds in the green as far as monthly change, and a couple funds in the red. But check this out, month over month, right? So we're taking these 2 months right here, and this is the column that just tracks the month over month distribution. I notice here that what it should say is AH and AI is what it should actually say here. The 2 columns that it's tracking, the change in those 2 columns. So that's something I'll fix after this video. We can see month over month, man, NVIDIA up 144% by yield max. That is insane. We saw on the Canadian side, not the biggest increase actually did come from Purpose Investments with their single stock ticker NVIDIA, and they went up like 20%. But that distribution is typically more stable. So to me, it's still great. And we also see a lot of the yield max stuff just heading skyward because of it. But what has been not so great? Oh my, there's a lot of stuff that has just fallen off, or that has fallen off the train in this case. Let's go down to what is the biggest thing? TYLG. Now, here's the thing with Global X type stuff. Global X is this is going to annoy me when it comes to trying to track data with Global X. Are probably going to laugh at me with the stuff I'm about to say. But sometimes they pay out twice a month. Sometimes they skip a month, and so that's going to create just oddities, I think, in the tracker in the tracker when it comes to the Global X information. And I don't really have, at the moment, I don't have a great way of trying to fix that without messing too much with the data at hand. So it's just something we got to be aware of with the Global X stuff. So, they paid out $2.20 in January. Wow. But the fund was paying out probably year-end like phantom distributions, which often come out at the end of the year or right at the beginning of the year. And January, I think, might have also been a 2 payout month, right? They pay out at the very beginning of January and they pay out at the very end of January. And oh man, so that is certainly, so anyway, spots like that are kind of going to mess the tracker up when it comes to Global X. Everything else should be fine, but some to keep in mind just with Global X type stuff. So for TYLG, I do have a distribution tracker where you can actually see that $2.20 is the anomaly. It's not the rule. So the fact that it's down big like that, it's a bit of a misnomer. But then as we kind of see with these other kind of Global X type funds, they're all kind of down within that same range. But again, most of them are fairly. Now, what I do actually like about Global X is they have sector funds, they have index funds, and they have different variations of the same fund. So things like XYLD, you'll have XYLG. So XYLD invests in 100% in the portfolio at the money, whereas XYLG invests 50% at the money. So it gives you, if you're someone looking for price appreciation and you're looking for that covered call the yield as well. XYLG could be a good option that way, but in perpetuity, they probably kind of act the same, just obviously with different distribution spectrums here. So they're all kind of fairly in that same ballpark. All right, let's go over to year-to-date change. Year-to-date change. Maxi at, what is that? How is that? So from the sorry, this isn't year-to-date. This is just from the very first distributions paid out, which you can find in the column right over here. So you can see that the very first distribution for Maxi was in October 2012 at basically 1.3 cents. It's gone up to 15 cents for a 1,000% increase. Pretty sure Maxi is one of these funds where its very first distribution was really low, and then it probably bumped up like 500% or something, and then it kind of stabilized at that point. So again, always go to the fund manager websites. That's where you're going to find the most up-to-date information on a day-to-day basis. And if something looks kind of peculiar like that, there's probably a reason for that. So if you look at the distribution history, if you even head in here, you'll see why that is. But I got to go with the very first distribution to here. We can also see some other amazing distribution increases. XYLD from the very first one till now gone up almost 700%, which is just great. But XYLD has been around for 10 years, so it has history on its side. And all these other ones fairly newer within the last year, and again seeing massive distribution increases. A lot of, especially with the yield max funds, very volatility heavy, which covered call premiums are tied to. The more volatile something is, the bigger your payouts typically are going to be, especially if you don't mind the distribution volatility. Then you can certainly plow into some of these funds and the potential for them to grow over time. Who knows, right? Then as far as we go down to the bottom, again, Global X, with those funds, just be careful with them, with how you measure or you do your research, especially if you pick up this the tracker for yourself. Global X, a little bit, if they could just make it every month. Like, it can be variable. I mean, I'd like it to be stable, but 2 payouts sometimes a month, skip a month, like, man, that's going to drive me nuts when it comes to trying to figure out like what kind of opportunities that we can have with Global X. So with that being said, let's kind of move into the yield tracker. This is just simply tracking the month over month change in yield, which price changes, yield will either go up or go down. So typically if yield goes up, price is probably going down. And that could be a good way of indicating an entry point into a position that you're interested in. So let's just kind of go quickly over month over month change. We can see yield month over month from February to March. The biggest increase is DJIA, with its yield going up about 14%. But as far as these other ones are concerned, we can see where the yields have actually decreased, mainly because the price performances have also increased, especially across many of the, just the technology sector in general. Year-to-date change, we'll take a look at that. Google with the best spot, its yield going up. So I mean, Google we saw in performance. That might be a good time to potentially get into Google, especially the single stock ticker if you're looking for a yield that's at around 30%. Maybe it's more typically in this range. Again, as the tracker builds out, we'll have a much better understanding of where sort of the norm is with some of these yields, and then we can actually take an average of these. We can take an average of all of these funds. So Google way at the top, and what's way at the bottom? Healthcare obviously has done really well. I think, again, with HYLG, its yield was somewhere around 28.83%. It's more actually in line with this, but we got to understand that a lot of those phantom distributions make the yield jump up, which again is going to just frustrate the living daylights out of me. But if there's a way that I can kind of fix it and kind of make it look more normal, it just means we got to pay attention to where the average is. And again, month over month, as the tracker builds out, you're going to see that a number like this it should raise red flags to go look further into it for yourself. But for at least this tracker, it simply just shows as being down 84%. Let's move into AUM. So we'll put, again, a filter view on that. Let's go to filter view. And now, again, we're going to use AUM, and we'll use average 3 months to check on the general health of the American covered call ETF landscape and look for those red flags as well. So again, we'll do kind of the month over month change. Some of these funds are brand new, so they don't necessarily have February to go back on. But as far as AUM, look at some of the funds that, once again, get rid of Canada. We're looking at US. Okay, so we'll have better, obviously, information come April, because all these funds were just added. So at least we can see what the AUMs are at right now. It gives us a baseline, and then come April, we can look at that month over month change. And the same is going to be for average 3 months as well. We'll put on a filter view. We'll get rid of Canada. And again, if you're curious about what the highest AUM is, I guess we can look at that. Or highest, I would say, trading volume at the moment is, we got JEPI, no surprise there. It's the biggest covered call ETF in the world, I believe, at $30 billion of assets under management. And then coming in second is the old dog, the one that everyone had always been talking about. If you're into income investing way back in the day, it was QYLD. And then we kind of go down the list into some of the more sort of, not obscure, they are, I would say, known. But as always, with liquidity, the lower volume trading there's a higher chance you could end up paying more. It's the bid to ask spread. If it's much tighter amongst the higher trading funds, like that band is tight, but it's much larger over here. So if you're interested in buying something like TYLG, or even, let's just call it XYLE, then yeah, it just has a chance to pay more, just because there's just not enough trading volume out there. So again, just watch out for that. And over time, if volume is trending lower, if AUM is trending lower, it doesn't mean that fund is going to go under tomorrow, but that's where the red flag would be. And watch the Canadian version of this update to get an idea of what I talk about when it comes to the red flags of 3 month volume, and when it comes to tracking AUM as well. But for the most part, all of these funds have great liquidity, even for stuff that's on the Canadian side, a good fund is like 25,000, whereas I'm sure for a lot of Americans, the stuff that trades in the hundreds of thousands is probably more normal. But again, for Canadians, our options market not as big, not as many. We have lots of covered call ETFs out there, but just the trading volumes are a lot smaller. So for us, this range is, in my opinion, considered good on the Canadian side. And I got no issue with any of this. But stuff that's under 1,000, you just got to watch out for. And as far as AUM, I guess we can kind of look at just what the biggest AUMs are. So as I said, JEPI, number one. Whoa, JEPQ, I didn't realize. I thought QYLD was still in the number 2 slot. And then we have the Global X funds, QYLD, XYLD, and RYLD rounding out the top 5. And then lots of other funds sort of in that, hundreds of millions of dollars. And even we got some funds in the hundreds of thousands of dollars. It's a lot of the Curve stuff. Curve and YieldMax. I think because YieldMax kind of jumped on the whole single covered call ETF stuff first, and because quite literally, yield max is just balls to the walls, yield first. Like if you are focused on yield and you are leaning more yield, then yield max is for you. But if you like the single stock ETFs, but yield max is maybe just a little too nuts for you, then Curve could be an option for you guys. It's much more, from what I understand, they're much more conservative in their approach with the single stock ETFs. Still the same format. They track the price of the underlying asset, just like yield max does. So you get exposure to the share price. You don't actually own the underlying stock itself, the underlying business, right? So last but not least, well, actually, we looked at volume, we looked at yield. There is distributions that you guys can kind of look through here. I've taken, oh man, I would say this tab was the most painstaking to go through, as all of this was just input by hand, especially, or data entered by hand, especially with the more variable stuff. And it goes back, all the way to, I think, to 2010, roughly. So if you are just interested in getting a history on the distributions, what did I do there? Then again, we'll get rid of Canada here in this case. Then you can certainly find it. Keep in mind, for which I probably should have led off with this, is that with the American stuff, because they pay out later in the month, the updates for these videos covering the American stuff is going to be, it'll cover basically February's distributions, as we have to wait further in the month for them to pay out. So I don't know what March's distributions are for most of this stuff. Whereas in Canada, a lot of the ex-dividend dates are right at the, say, in end of February, and then get paid out in early March. They get paid out in the early part of the month. So it's much easier on the Canadian side to, say, do an update, say, for March. Whereas the March update for American stuff is actually just looking at what actually got paid out in February. So I'll make that clear in the next tracker update to lead off with. And but basically that's all the information. So hopefully you all enjoyed the looking through all this data, and hopefully there were opportunities that you can find in this, and check it out for yourself. If you are someone who's wants to get into the space and learn more about it, this I want to be the undisputed best tool out there for consolidated, updated information on a regular basis. I'll continue to do videos about all this stuff, and well, with that being said, hit all the buttons of the like and subscribe variety, and I'll see you all in the next video.